Good morning, everyone, and thank you, Denis. Thank you, first of all, for welcoming us, 2 years in a row for this TLF. So, on behalf of French Founders and Tikio, really appreciate you hosting this event. But also thank you because you agreed, to have a little chat with us, and you don't go public that often, apart from this week, which was a busy week for you.
This is true.
And so we also appreciate, getting your perspective on many topics that I'm sure will be of great interest, to the audience. And I mean, going back to this week, obviously quarterly results, for Goldman Sachs. Another great set of results. If I'm not mistaken, your stock price is, all-time high. You've been CFO for 2 years now, alongside David. After a long, career that I need notes, to comment, for the benefit of our friends here. But you joined in 1996. That makes us around, the same generations. And being called veteran in the industry is something that I was not, really expecting. So congratulations for that. But you're also a left-fin banker by background, leverage finance banker by background. So I know we discussed equity a bit earlier, and I wanted to touch base, on credit. Obviously, I mean, you held a multiple position, here in the US, in London, where you spent, most of your career, half of your career. You co-headed, the credit group. You were head of the credit finance, over there, and you ended up being head of the European, Middle East, Africa financing group from 16 to 18, before being the co-head of the global financing group, and then taking on, the role of CFO. But the other important thing that happened this week is that yesterday, if I'm not mistaken, Blackstone, a client of yours, a competitor of mine, or an inspiration of ours, passed the 200 billion market cap. And when you and I, were leverage finance analysts a long time ago, effectively we were financing, those people, and now those people, this big, alternative asset management world is developing, and they are becoming, one of the great source of funding. Obviously on the equity side, but more and more on the debt side. So that's why I wanted to start the discussion, because you expanded on the conference call. Are the asset managers the new master of credit, or are banks back to the vengeance?
Okay. Well, Mathieu, thank you very much for the kind introduction. Thank you to all of you for coming in and spending some time here at Goldman Sachs. It's our absolute pleasure to host this event. So thank you for spending time with us. I guess to jump right into the topic of private credit, alternative asset managers, roles of banks, how can you avail yourself of risk capital? How do you approach the market for helping you grow companies or grow the businesses that you're associated with? I guess our perspective is that there are multiple parties that exist inside of this ecosystem. I will give it to you from the Goldman Sachs perspective, but we intersect, we believe, with sort of each segment of the market. But maybe in telling you the story through that lens, you'll get a sense for how we see the market. So as Mathieu said, there are these alternative asset managers who are investing money for their clients. They very frequently like to secure financing themselves so they can apply leverage against their portfolio of assets. We are one of the leading providers of that financing to them to lever up their portfolios and their assets. We call that our FIC financing activity. The second way that we intersect with these clients is sometimes they like to buy businesses, and they need money to buy businesses, and then we help them do it one of two ways. We either underwrite high-yield bonds or leverage loans for them and sell them into the institutional investing community of the world, or we offer them a direct investing solution, because our asset and wealth management business has been investing in credit for about 30 years, and we have some of the largest, most well-established funds across all credit asset classes. So we offer the clients either an underwritten solution or a direct investment solution. And then the third piece of the puzzle is in our asset and wealth management business, that fund that I referenced, we are developing more funds that have various types of private credit and alternative offerings, because there is a world of investors that wants to get exposure to that asset class. So we have people that want to borrow from us. We have people that want to invest with us. We have people that want to procure direct investment and underwritten solutions. And so the world of private credit is now very big and diversified. It's not just non-investment grade, which is where we grew up earlier in our career. It's spanned across multiple asset classes, including, importantly, investment grade. And there's a lot of current growth and expected growth that we see as well that should occur across investment-grade private assets as well, that has a very interesting place for investors in their portfolios.
And you capture that at Goldman Sachs, maybe for some of the people in the audience less familiar, in the way you pivoted almost structurally, your asset management business, your principal business that obviously was at the core of Goldman expansion back in the year, and listening to you and David on the call earlier on this week, it's a huge focus on this asset management and wealth business. And that's for me, again, trying to, to follow on the discussion and the panels, you had earlier on today, because I'm sure that many of you, are focused on funding, funding your own business, small, medium, large business, funding with debt, but also accessing, to equity, because I'm sure everybody's picking up very often the fact that there might be a bubble in private credit. There is way too much debt, in the system. If I may, there might be way too much debt in the public system, but certainly not in the private system. And so I wanted to pick your brain also on, companies cannot only be financed through debt, right? We all agree on that. And the private equity market at times is also maybe reduced to the buyout market, which is another part of the segment. But how would you see today the access to private funding through the equity? I don't want to call it private equity, but private funding to equity. And how do you position yourself also vis-a-vis the market that we discussed earlier? How do you see the equity market opening?
Sure. So from our standpoint, in order to generate a lot of economic growth in any particular region or environment, you need to have the capacity for people to take risk and to innovate and to grow. And there's no shortage of people and companies around the world that have ideas about how they can grow, but enabling them to get access to the right form of capital is what's more challenging. And it can have different types of challenges across many different jurisdictions of the world. There's a well-developed continuum of equity risk capital that can be deployed from very, very early stage venture capital to more mature buyout capital, growth capital in the middle. And for us and for our clients, our job is basically to advise them based on their stage of development what might be the most attractive type of equity capital for them. And if we have the capacity to provide some of that equity capital ourselves through our funds, and we have a variety of different funds in our asset and wealth management business that are in the business of investing with clients and supporting their growth. And if we don't have the right solution for them, then we obviously know a lot of the other players across the continuum that we could put them in touch with to make sure that they secure the equity capital to grow. But I think this is a very important topic, and as you look around the world, and we have large amounts of debt, as you say, public debt across countries, across companies, and we have this desire to grow the economies around the world to improve wealth and opportunity for people, we need to be able to unlock allocation of equity risk capital as a really important component, and that's something we spend a lot of time on.
So the environment, maybe on the back of COVID, on the back of interest rates picking up, even if they're going down, we can come back to that. We've seen a significant slowdown in deal activities, in IPOs, and we discussed earlier on the panel. M&A obviously is a big driver, but you're obviously you know a lot of things that we don't know, given the reach you get across the global economy. What is your sense in October 24? Where are we in the cycle of deal activity picking up?
So we're pretty optimistic. I think we're in an upward swinging part of the cycle, and I agree with all your comments in terms of where we have been since COVID. But for our own business, and Goldman's fortunate enough, we have one of the leading advisory businesses around the world, and advisory mandates and activity often is the leading, the tip of the spear, if you will, on other types of capital markets and deal activity in the world. And we keep reporting to our investors that our backlog of activity coming in from an advisory perspective is growing. So that gives us confidence that there is more room to run, and that we could have a very positive economic and deal activity cycle over the next couple of years. The other thing that I would say about the nature of the activity that we've seen is all the capital markets are open. I'm sure anyone who comes up here today will tell you that the investment grade markets are open, the non-investment grade debt markets are open, the equity markets are open, even the IPO markets are open. But within the distribution of the activity that we've seen year to date around the world, we don't have a high concentration of the most strategic and deal-related activities. So in debt land, it's a lot of refinancing activity. That's a smart, sensible thing for companies to do, having come out of a period where there was uncertainty and they want to de-risk their capital structures. But we don't see a lot of leverage buyouts, public to privates, cross-border acquisition financings. We don't see the big types of transactions that generally show up on the front page of newspapers. And while I'm sure my colleagues will tell you that the IPO markets are open, and they are open, and they're up year over year off of a low base, IPOs are 50% below the 10-year average level of IPOs. So when I, again, talk to our external shareholders, I don't celebrate that the IPO market is open. I tell them, we're way below 10-year averages. There's a lot more activity that the world could see coming through. And leverage buyouts and public to privates and capital committed cross-border acquisition financings and IPOs, those are the things that are attached to new deal activity, new company formation, change of control transactions around the world, whereas the refinancing activity that we see in high volume, that's sort of a static position, a static snapshot of the portfolio of companies in the world. So yes, things are better, asset prices are higher, credit spreads are tighter, volumes are up, but the most interesting transformative activity across debt and equity markets, we haven't really seen it yet at scale. And that's a big opportunity. Indications we have is that we're moving in that direction.
So here's maybe a tricky one, I don't want, but what is the average 10-year IPO trading price today? Above or below?
Where is the average IPO
basket
issued in what period?
Over the past 10 years, the same average, that's, maybe it's a tricky one, but that could be
it's a tricky one. I don't know the answer to that.
Yeah.
If I had to look at every IPO issued in the last 10 years and then aggregate their index trading level, I do not know the answer.
Okay, no, but
someone in Goldman Sachs might know the answer, but I don't know that.
I had to catch you on something.
Otherwise,
it's too easy for you. But the reason I'm asking that, and we don't have time, unfortunately, to go there, is effectively to pick up on the efficiency of the capital market. The stock market is trading at all-time high, but we all know there is a massive dispersion between the components, of the index, the techs, etc. We just said the debt markets are wide open. There's no shortage of financing. You're pretty optimistic on the deal activity picking up. So maybe another one. Don't know if it's a tricky one, but what would you say is the one risk which is not priced by the public markets nowadays?
Well, I think the markets, they move to consensus positions very quickly, and you always have to keep yourself mindful of the tails. So I think the world has concluded that the U.S. is headed for a soft landing, and we agree with that. And the rate cycle around the world is now trending lower. And despite an incredibly turbulent time, central banks across the world have done a pretty decent job of stabilizing their economies and getting them headed in the right direction. But God forbid they don't have it under control and we have some inflation snapback. That would be a big shock versus people's current expectations. We unfortunately have a whole bunch of geopolitical risk going on around the world, which as far as I can tell, the markets have generally seemed to ignore. But there is embedded risk right in front of us across multiple theaters of the globe. And then one thing that I just spend a lot of time thinking about, particularly given my role within my firm, but I think it impacts everyone, is cyber risk, which is just one of those things that we have less control over. There are bad actors all over the world doing all sorts of things. One of the spaces they do bad things in is cyber. And that's something that, given the world's interconnectivity, can start somewhere, spread elsewhere. So I think about that. If you don't spend any time thinking about the cyber risk of your portfolio companies or your own company, which I doubt is the case, but you could probably always spend a little bit more time. We spend a lot of time on that topic at Goldman.
So ESG should be more like ESSG with security, and that's a private joke because ESSG was one of the leading principal business of Goldman Sachs. But speaking of that, because it was European, special situation, ESSG, you spent half of your career in Europe. Mm-hmm. Obviously, Europe is a complicated market that you've experienced. We've got a single currency, but many different culture, not to mention language and politics. What's your take nowadays on Europe? Is it a threat or an opportunity for Goldman Sachs?
Well, first of all, I have incredible personal affection for Europe. I was so happy that I got to spend half my career in Europe, and I had a remit that enabled me to travel all over. I'm sure people in the office probably know we've been in France, for example, for about 37 years. Our first operation in continental Europe. We just opened brand new offices in 22. We've tripled our headcount in France in the last couple of years. We have #1 advisory market share, top 3 FICC and equities. It's a really important place for us. We've been there for a long time, and we see lots of opportunities there particularly. Across Europe, I find it fascinating, complicated, challenging, much more difficult to operate in Europe than the United States. I constantly tell all of my American colleagues how easy they have it on a relatively speaking basis. One language, one legal system, one country, different fee structure, different competitive dynamics. But there is, by definition, an opportunity as a result, because the whole continent is going to have to wrestle with the growth question in order to solve its ambitions. And I suspect there will be more need for collaboration, working together, knitting together of different markets and structures, which I don't underestimate the complexity, but I think progress in that regard, which I think a lot of people are committed to, could unlock a lot of value across the continent. And we want to be a major player across EMEA, continuing to develop, capital markets, economic growth, et cetera. Great client franchise, incredible group of companies. We've been committed. We remain very, very committed to.
For European entrepreneurs, in the room and leaving politics aside, obviously, and I want to talk about tariffs, but would you encourage them to come to the US? We did that, at TKO 5 years ago. It's a challenge, but would you say that's a market share for grab for you as well?
Look, I think there are opportunities everywhere. So it depends, what is your idea? What is your point of differentiation? What is your edge? Are you going to be able to attract funding support for your idea? Are you going to access customers? Where do you need to access talent? And for our businesses, there are lots of our businesses where it's quite important to be co-located with clients. There are other activities that we have at Goldman Sachs where we can perform a function or provide a service from anywhere. So as to entrepreneurial opportunity, welcome plenty of entrepreneurs to the United States. There's many, and love to have them across EMEA and the rest of the world. Frankly, lots of different opportunities.
You should take note. Goldman Sachs is here, to help you. But before we wrap up time, a more personal question, which is maybe a bit of a fiction. So if you allow me saying, you started your 29th year at Goldman Sachs, so soon to be 30, and then here a little fiction. You get a call from David telling Dennis, you had a great 30 years, so take 1 year sabbatical, okay? So first you have to tell me if you go back to Paris or London, first of all. Yep. But the second question is you say, okay, I'm bored, with dealing with all this financial stuff, and you can only take, one asset to park, your savings for this year you're taking as a sabbatical, and you've got 3 choices. Okay. One is a global equity ETF. Okay. The second one is 10-year treasuries. The third one is a BB high yield index, since you come from there. I had a fourth one, which was a basket of Goldman Sachs and TKO shares, but that was, refused by compliance. So I leave this option aside. Okay. So which one do you take? So, and are you projecting that I'm going to get that phone call at my 30th anniversary, or is it some because that's very soon? You have to get organized, okay? So you're a few months away, you have to get organized. Let's say it's right here, right now.
So there are lots of opportunities that I've had working at Goldman Sachs, but having spent most of my career in the investment banking division, and speaking of compliance, I was unable to make single name investments from a compliance and the way we operate and run things. So only type of exposures were index. So I don't actually have a lot of single name investing opportunities. So I would probably punt to index type exposures like you indicated, and I'd probably just go long global equities. Equity, which is the optimistic asset class, for anyone who's in the business. So ladies and gentlemen, Denis Coleman, thank you very much. Thank you, Mathieu. Thank you all very much. Super.